Welcome. Good morning. Good late morning. Good afternoon to everyone joining us. We're super excited to welcome you to our first session of our six-part fundraising series. Before we jump in, I wanted to introduce Sparrow, but also introduce kind of the goals for this series as we kind of progress through the next 4, 5, 6 weeks. So just real quick with kind of who we are at Sparrow. We are an early stage venture firm investing in the things that make life worth living. And for us, that falls into 3 buckets: well-being, work and purpose, and human connection. We're investing in startups that have purpose at their core, that have a real mission that they're chasing and can scale to become billion-dollar companies over time. And so we're looking to work with founders that are building a future that we all want to live in. And so that's us at Spero. We're a team of about 8 or 9, depending on the day. We've got wonderful summer associates joining us that are absolutely elevating our brain power. And we're based out in the Bay Area. And here's where you can kind of find us on social, as well as some of the participants on today's panel. And then real quick, before I turn it over to introductions, I want to run through just some kind of high-level goals for this 6-part series. So really, we're looking to kind of help early stage founders understand the nuances of the venture capital fundraising process and answer common questions that we hear from early stage founders who are new to the venture capital ecosystem. So that's questions like, how much should I raise? What are the metrics I need at what stage? How much of my company should I be selling in each round? And also provide actionable insights through different sessions and conversations, but really helping you understand things like how to nail your pitch deck, how to nail the pitch itself, how to run your fundraising process, and how to build financial models, how to organize your deal room. Hopefully very actionable things that are either out there and hard to find or don't quite exist yet out there on the internet. So this is meant to be, quality content that we're hoping to democratize and bring to folks that are having a hard time either finding it or don't have the networks to get those questions answered. And we'll also be having higher order conversations that hopefully will help you think about what are the best strategic decisions and the right paths for your companies in the early days. And that's kind of where we're going to start today with our conversation about what is venture capital and why raise venture capital? Should I raise venture capital? What are the other options? And we have an incredible lineup of folks representing a broad scale of the early stage funding ecosystem. And I will let them introduce themselves, but super excited to have them. And I just want to say thank you again for joining us and giving us your precious time to drop some knowledge on these folks. And be ready, everyone. This group has a ton of energy, so it's going to be a lot of fun. So I will kick it over to Cheryl. She can introduce herself, and then we'll popcorn around to the rest of the group.
Awesome. Thank you so much, Evan. That was an amazing introduction. Hi, everyone. I'm so excited to be here. Happy Friday. Let's go get it, guys. Get your goals. Do everything you need to do. My name is Cheryl Campos. I am a director of growth and partnerships at Republic. We are a spin out of AngelList that allows anyone to invest in startups and for startups to raise up to $1 million in capital. Fun fact, in the fall, that 1 million will increase to 5 million, which means that there are going to be more companies, I guess, higher upstream that will actually fill their full rounds on our platform. So super excited. We already have a bunch of companies in the pipeline for that. But yeah, we've helped over 150 companies raise over 50 million so far. We have 700,000 investors. So people all around the world that are looking to invest in startups. And yeah, it's been 4 years of an uphill battle of, people out there hating on us, and now we're clearly showing that we have the power to democratize access to investing and fundraising. 40% of our founders are female, 20% are Black and Latino, and they hail from over 30 states. So we have a really amazing diverse portfolio, and we're looking to increase those numbers. So I'm happy to be here and excited to talk more about Republic.
Awesome. Thank you. Brittany, you want to introduce yourself? We'll go to Lolita
Yeah,
first.
sorry.
And then, oh, there's Brittany. We'll go to Brittany. Thank you.
Oh, sorry, I'm having some data issues, I believe. My name is Brittany Henry. I'm an associate at Impact America Fund. Excited to be here. Happy to answer any questions everyone has, and looking forward to the conversation. At Impact America Fund, we invest in tech-enabled businesses that provide economic agency to low-income communities of color. So that's a lot, but basically what we're looking for is founders who have a strong understanding of a problem and are offering a product or a service to low to moderate income communities of color, and are looking to invest in them and be able to really support their mission and scale up their company, but also on the impact side. And we're investing in companies from seed to Series A. So looking forward to speaking more about it.
Awesome. Bryce, you want to introduce yourself?
Happy to. Yeah, I'm Bryce Roberts. I run a fund called OATV. We started that back in 2005 as one of the early, early seed funds, one of the first institutional seed funds. And a few years ago, we started developing a program that we call NDVC. And NDVC is designed to fund people to profitability, not to their next round of funding, although it doesn't exclude that. And so it's just a different kind of company than those that would historically raise traditional venture capital. We think that both the demographics and geographies of venture or that are emerging aren't necessarily well suited for venture because venture is a very niche product. And so, I think what's interesting to me, even about the title of this session, is that we're talking about, should we raise venture capital? And I think that's actually not a very interesting question. I think the question is like, should we be raising funding? And if so, what kind of funding? And I think, unfortunately, when we're talking about where we've kind of taken all of the education and all the energy in startups is to point it towards venture capital, when venture is like really a very specific hammer to hit a very specific kind of nail. And I think the work we've set out to do in the last 5 years, and we plan to spend the next 50 years doing, is making sure that there's a lot more nuance and a lot more options out there for people, building all kinds of different companies, scaling all different kinds of companies, because we don't believe venture scale is the same as blitz scale. But right now we're funding everything with that same model. And so that's me.
Love it. Thank you. Lolita, over to you.
Thank you so much, Stephen, for having me. And Bryce, you couldn't have said it better. I literally wrote a post and I'm thinking of retitling it just based on your feedback, because this is true. I mean, and Stephen, this is one of the questions you're gonna ask, but I cannot like double click enough on what Bryce just said. Should you even be raising? And if yes, which capital suits you best? So I'm Lolita Taub, and I'm an operator and an investor in early stage tech companies. And I actually have the honor of working with Cheryl as a venture partner for Republic, as scout for Bryce. So I love them both. Brittany, I think we need to connect more so we can work on something together too. And really what I'm about is getting together with founders, supporting underestimated founders, in particular as a woman of color, a Latinx founder myself of the Startup Investor Matching Tool. I really want to provide the opportunity for founders to connect with the resources that they need to be able to succeed. And they look very different depending on the kind of company you want to have. You have your ambitions and where you lie in the market. And so I'm super excited to have this conversation. And thanks again, Stephen and Bryce, Cheryl, Brittany, super honored to be on a panel with you guys.
Awesome. Well, I'm going to kick it off with a question for you, Lolita, just given kind of that you sit at such a unique vantage point across all these different spectrums or pathways within these early stage financing options. And so I'm curious, I guess, what are some of the questions you ask founders when they come to you seeking advice? And I know you just dropped an incredible blog post that we will be sharing afterwards that really breaks it down. But I'm just curious how you kind of frame that conversation, the questions you ask, and how you challenge people to kind of think about this first question.
Yeah, typically I get this question of where should I get capital? Can you introduce me to an investor? And I say, wait, can we back up? I need to understand what kind of business you have and what you're trying to achieve. I think this is so important, because if you are able to answer this and have a scope of where you land in the spectrum of, are you a small, medium business? Are you a rocket ship? Are you somewhere in between? The answer of what kind of funding you should be raising, and even if you should be raising, then arises. It turns out that a lot of the conversations go into, maybe you should just bootstrap and figure out what you want to do. Because, for example, if a company wants to, if a founder wants to build a company and they want to grow organically, if they want to keep a small team, if they don't care about exiting and they care about keeping control and equity, I have a different answer to how to raise capital than if someone says, hey, I'm ready to go, I want to exit, I want $1 billion, valuation company. And so finding where you are and then understanding why you're even raising money. Like, what is it going to get to you? Oftentimes when I ask, what milestone are you going to achieve with this? What kind of return can be expected from this investment? Oftentimes founders don't have a clear answer on that, and it's really important to get clear on these things. So again, why are you raising? What kind of aspirations company do you have? What kind of capital options are available? And will this approach or strategy that you're choosing help you get to that next milestone that you're trying to achieve, to not just go fundraise forever, but to build a business that will grow? So just a little bit on that.
I love it. And Cheryl, being at Republic, which is kind of trying to shepherd in this new category of crowd investing to the world, I'm curious just kind of what your perspective from your pitch is, and kind of if you could really just talk about kind of what's different about Republic's model, what's different about the crowd investing option, and what are kind of the potential upsides to it compared to traditional venture?
Yeah, that's a great question. I'll actually drop, since the chat, by the way, is active right now. So thank you guys. I love to see it, like listen to the speakers and then also, communicate. So I'm a big fan. I'm going to drop in actually right now our link to, just for startups in general, as to like why, if they want to go this route, why. Our biggest hurdle really though at the end of the day is education. People don't know that Republic exists, but when they do, they're like, oh, it makes so much sense, right? Through a campaign, not only are you able to fundraise, and the average, by the way, campaign size is 500K. Not only can you fundraise, but you can also market. You can engage your current customers, market to new customers, really kind of create lifelong brand ambassadors that are all around you, right? Crowd investing at the end of the day is really the intersection between angel investing. So, just regular angels writing large checks that are accredited, and then rewards crowdfunding, which is the Kickstarters of the world, right? We're right in the middle where people can go and founders like yourselves out here, all the 60 that we have, can go and actually just give a little piece of your company to those that are, making it successful, your customers, the people that really believe in you from the beginning, not folks that are going to look at you with a blank stare across the fundraising table, because depending on just regular VC, you might have to do that a lot and, get a lot of rejection. And instead of pitching that same story over and over to hundreds of VCs, you can actually create a deal page where thousands and millions of people a month see it. And so that in itself is a lot of exposure that you can't really buy. And so for us, we like to see companies that are, pre-seed through Series B, companies that have to be US incorporated though, are looking to, either top off round, maybe just market, or they want like a bridge round. We've seen all these different places where they kind of use Republic as part of the capital continuum to really mold the rest of their round. And so, it depends on the type of company at the end of the day. We're industry agnostic. We're looking for companies that, for founders in particular, that can do the work and are eager to really bring their community, because at the end of the day it is a partnership. They bring the community, we bring our 700,000, and that's kind of how we're thinking about this space, right? It's really just one piece of all the different things that are out there, whether it's, bootstrap VC, whether it's, micro lending, whether it's all these pieces that you put together as a founder to really understand more about like how you can really leverage a Republic campaign to the best of your ability.
Awesome. And before I pop over to Bryce for a question, I want to flag that we're going to be doing kind of an open Q&A for the second half of this session. So please drop in your questions for the panelists, either an individual or for the broader group, and we will be flagging them down and kind of turning it over to you in the second half of this call. So with that, Bryce, I was a fly on the wall at a conversation you had with some former colleagues of mine at Village Capital, where you were really talking through kind of the founding story of OATV and kind of the gap that you saw then, but then the gap that you kept seeing that led to NDVC over time. And so I'm just curious if you could speak to that kind of like the gap you saw for before you launched OATV in that institutional seed funding space, but then how you also kind of saw parallels or similarities or opportunities as you evolved and then subsequently launched NDVC.
Yeah, sure. Happy to talk a little bit about that. I mean, back in 2005, it's hard to imagine now, but there used to be this big gap between angel investors and VCs. There weren't institutional seed funds. There weren't people writing, 500K checks, 100K checks. You were getting 20K checks, 50K checks, 100K checks. And even then, it was only from a very, very, like that pool of angel investors was just so small. And so our original pitch for OATV was like this intersection of these emerging technologies were driving cost out of business, out of starting and scaling a business. And so the cost to start and scale something was falling through the floor. And yet, we essentially were only structured to support, the kind of historical things that venture is really designed to do, which is like big technical risk, big swings at there's kind of two ways to think about rocket ships. One is like a growth trajectory, and one is actually a physical object that takes off from a landing pad. And like that is what venture is designed to build, but we've equivocated it with the growth part, which is only somewhat correct. So that was the original gap we saw forming. 10 years in, that gap wasn't there. Like, today we started, there were 5 seed funds there. When we when we started NDVC, there were probably 500, and now there's going on 5,000 seed funds that are out there. And so, we just didn't find that gap existed anymore, but also almost as importantly, that gap was now filled with funds that viewed their customer as the Series A investor, right? And so when you view your customer as a Series A investor, you start to take on the same investment filter, criteria, pattern matching that they take on. And today we're having a little bit healthier of a conversation about what effects that has in terms of who has access to venture capital. And the numbers are, to those who haven't been paying attention, I think they're realizing they're shocking in terms of the demographics and geographies that have been left on the sidelines. But I think just as importantly, the gap we started to see opening up was that there was a different class of entrepreneur, a different class of opportunities that didn't require that same wild swing of risk capital, but that could still have a venture scale outcome. And those didn't sit between angel and VC, those sat between banks and VCs, right? And so, between debt and equity. And so we wanted to explore that space with kind of a hybrid product where, you could still have that venture scale outcome and actually even follow that same route if you chose to raise another round of funding in the future. But if you found you just had a great business that you loved running or that you didn't want to switch tracks, we just needed a way to be able to get our investment out. And so, we created a system where after a given period of time, you can start to repurchase the original equity that we had an option on at our first investment. And so, candidly, we think that gap between debt and equity is way bigger than any gap that was between seed and between angels and VCs. And so, that's where we're kind of dedicated to as a fund to continue exploring and iterating that. And so, I think we've got our core NDVC product. Lolita mentioned she's a scout for us. We've been iterating on some different products for our scouts to be able to go to market with. And then we have an intro product that kind of fills in some of the education and optionality around non-dilutive funding that we won't provide directly, but that we've created a network of lenders and investors who are interested in finding an outlet for their products. So that's at intro.me.
And quick follow-up, are there any interesting takeaways from your early cohorts of the NDVC model? Like, does it look different than traditional venture? Could you speak to that?
I mean, I think there's probably two dimensions that looks a little bit different. One, or even similar. One, we're, among a certain group of companies in each cohort, we see a similar breakout in terms of acceleration once they have the investment and support of NDVC. So our average growth in the first year across the cohorts is 100%. Average growth within 2 years is 300%. There are some companies who right out of the bat are doing 300, 400, 500% growth. So I think this idea that, venture is the fuel for growth is only partly correct. I actually think so much of it is really driven by where your energy and focus is. And I think right now the market is so diffused because that energy is so diffused because so many entrepreneurs are chasing funding instead of just building the business. The kind of consistent theme we hear over and over is anyone who'd been on that funding treadmill who was finally able to get off it with NDVC, they're just relieved that that's a whole, likely 50% of the business that they were spending time on before that they can now dedicate to actually scaling and growing revenue. So I'd say that piece. The other piece that, I think was interesting right out of the gate, unanticipated, but something we've highly valued is, the diversity of entrepreneurs who are attracted to it is just phenomenal. And so, from our very first cohort, we had 8 companies in that first cohort. 6 of those 8 were led by female founders and 2 of those by Black founders. And it was just there was this kind of immediate resonance from founders who valued building something, but that recognized that either them personally or the way they thought about building their business wasn't a fit for how Silicon Valley and blitzscaling talk about building a business. And so I think, we've really been able to find and elevate voices and work into networks and find our place in there. And we're finding that, entrepreneurs, in our very first cohort, we have a Black female founder who didn't know what Y Combinator was. She came through the foster system as a kid. She didn't have any support for her business. She's now doing 10 million a year in revenue. She's throwing off 5 million in cash. She's buying buildings in her own communities. It's just been incredible to watch. And so here's a person who, wouldn't have had that support historically, but she's she's currently building a venture scale business on the back of her own cash flow and not having to ask anybody for permission to do it.
I love it. Thank you. And again, keep dropping those questions in the chat. But before we jump over to the group Q&A, Brittany, I wanted to just give you a chance to talk a little bit more about kind of how you all at the Impact America Fund think about impact investing and kind of how you differentiate it from traditional venture. Because I know you all have a really interesting kind of way that you articulated that I think drives a really differentiated product that you're offering. So I'd love to hear how that shapes kind of how you evaluate businesses and your overall strategy.
Yeah, can you guys hear me?
Yes, we can.
Okay, great. I just want to first acknowledge I love the energy and the different models that everyone is speaking to on the call. I think at Impact America Fund, because we are a female Black-led venture capital fund, we sometimes we attract a lot of minority founders, and we're man, it's a really good business opportunity, but it may not be right for venture capital. So I'm excited to continue to build with the other participants on the call because I think it takes more than just venture capital, which the other panelists have alluded to really be able to support and grow the businesses in the ways that make the most sense for the business and for the founder in their strategic direction. So just wanted to add that. But at Impact America Fund, as I mentioned, we are a traditional venture capital fund, so we are looking for that growth. But in addition to that, we're really thinking about, for this particular business, how are you thoughtful about the impact that it's having on the low to moderate communities of color? And for us, that has to be what we consider inherent in their business model. So how we think about it is, if this company, if your impact were to break, for example, as that company grows, then that business model breaks and you no longer have a company. So what that looks like isn't necessarily, hey, I, produce a product and then I am using some of the profits from that product to support a cause that I care about, because, as you grow a business and things get tough, you could easily, no longer have that charitable arm. And so we're really thoughtful about, and we consider that ourselves to have a really high impact bar, because we want that inherent impact, and for that, your financial returns to really be tied to the impact that you're having within the community. Mm-hmm. So I hope that answers your question. I will also add that our investment thesis is really around economic agency. And so that looks across industries. That could be, a skills development program that makes the cost of accessing education decrease. It could be a fintech product. It could be across the board from an industry perspective. But really, we have a really high impact bar, and it's about making sure that those financial returns are growing at the speed or right alongside with the impact you're having on your end customers or the individuals you're supporting.
I love it. And I think, at Sparrow, I think we share a similar kind of worldview, in the sense that, like, companies that have a core mission are ones that are going to have a better opportunity to scale and can and at scale create real impact. So I appreciate kind of your worldview, and I think there's a lot of overlap, and we need to connect offline, Brittany, at some point.
Definitely. I'm looking forward to connecting with everyone on the call, because I think, like I mentioned before, there's the VC. I say this as someone that works for a venture capital fund, but isn't the only way or the right way for everyone, which I know that the other panelists have mentioned as well. So
for sure. Awesome. Thank you. So we got a few more questions for the panel before we open up to the Q&A. So keep dropping those questions in there. But I wanted to turn over, I guess, to Bryce and Cheryl. This is a question for both of you, given that you kind of have the, I guess, quote unquote, alternative-ish models. But like, I'm curious what you've found, if there's a kind of profile that is either a profile of the founder or a profile of the company leading into the investment that you think makes them uniquely fit, or your product uniquely fit for them. I guess we've talked about it a little bit, but I really want to, like, if we can break it down, just to see if there's any, to help these founders understand what mold they might fit into. And maybe it's not ubiquitous, but I'm curious what you're seeing. So Cheryl, maybe you want to kick it off?
Yeah, no, great question. So just to clarify, we are both complementary to VC and also an alternative. It's very strange. We've had people have bootstrapped, and then we have people that have raised 18 million from Greycroft and Lair Hippo and all of that. It's actually called Kangaroo if you're interested in looking at it. I'm just going to drop it once again in the chat and you can take a look. That's kind of the deal page, actually. So anyway. Yes, we essentially look for US-based companies that have at least some traction, so post-revenue, post-product, that have some community around them. But in particular, it's really just about showing the story. Do they have a compelling story that we think will be attractive to our investor base? Our investor base over time, we've seen have kind of fit into like 3 buckets. They either want to look at the really like kind of sexy topics, so like cannabis, AI, like all of those, like that seem like super futuristic. They're like, we're here. So that's what they will invest in. They will also invest in kind of deep tech or biotech. Actually, a couple of our $1 million raises, we've had $16 million raises now. A couple of them have really been about curing cancer. So I think there's a real element of backing some of those companies that are trying to do good. And then last one, which is kind of tied to this one, is a little bit about social impact. So companies that are either, focused on climate change or doing all these things that are good for the future, people want to be a part of. So those are kind of 3 buckets that I think we've seen the most companies be a part of. But that being said, we are industry agnostic, and there's definitely some companies like in construction tech, for example, that have also raised a full million simply because they were able to galvanize their community. They were able to efficiently tell their story through the deal page. And they were also prepared. I think, so in terms of the process, right, we actually accept less than 1% of companies now that apply, which is kind of crazy because we have 5,000 applications a year. Actually, that was last year. So I think this year will be a lot more given that, you know, Silicon Valley shut down and we had an influx of applications that came in and through March and now. But essentially, we make sure that we have a due diligence process, the IC votes on them, and then they actually onboard with us. So we make sure to hold their hand through every step of the process on that side, and that takes about 3 to 4 weeks. But then even after that, we make sure to put in money for marketing because marketing is very important during a campaign. So we actually deploy $2,000 in Facebook and Instagram spend. But then I think what separates a good campaign from a great campaign is really founders that are eager to, you know, spread the word. Founders that have also really prepared themselves for what it takes to, you know, make a great campaign. One of actually our founders, Pierre, he raised a full million. He's actually a backstage company and Lolita knows him well. And he was actually one of those who are he just naturally hustles. And so he knew from the very beginning that he had to really bring everything to it. And we have a strategy playbook that we work with every single company with a campaign marketing manager to really set them up for success. So those that are best prepared are the ones who really benefit the most from a Republic campaign because then they get the money and they also get the marketing along with it.
Love it. And Bryce, I think you hit on it, but just like if there's anything you want to kind of double tap on or hone in on, like what is unique about maybe the founder mindset or the company itself that differentiates it?
Well, it's probably, you know, I think that a story that I go back to or a conversation I go back to over and over again when it comes to this question is one I had years ago with a founder of a company called Qualtrics. And Qualtrics probably most people weren't paying attention or didn't hear about it until they raised a big round of funding from Sequoia and Excel. And then they ultimately ended up selling to SAP for $8 billion. And so people want to focus on the outcome, but I think the conversation that really informed a lot of my thinking around not only fit and profile for NVC, but also fit and profile around venture is, you know, Ryan and I were talking one morning. I live in Utah, he lives in Utah. We've known each other for a while. And, you know, he said something to me that seemed so counterintuitive, but yet makes so much sense. And that was, he said something along the lines of like, raising a seed round would have been the worst possible thing for our company. And I sat with that for a minute. And you know, like I said, I mean, it's such a goal for so many people to raise that seed round. Like, why would that have been a bad thing? And he said, look, the worst thing that could have happened to us was to raise the seed round, because what would have happened is we would have shifted our focus from this small niche where we could be really profitable and own a massive seat at the table. We would have had to give that up for the kind of venture scale enterprise opportunity. And in doing that, what we would have missed out on was all the learnings from that, all the like cultural strength that they built up around revenue and profits and like needing to be profitable early on. They would have skipped over the SMB market that by the time they actually raised that round and switched to enterprise or kind of grew into enterprise, they were throwing off 40 million in cash just on the kind of small survey niche they were in and then moving into SMBs. And so, you know, I think we get hung up on this idea that a seed round is going to solve all our problems, when in reality, for most people, it actually creates more problems than it solves. It moves you out of a focus on building something and scaling something real, and it gets you caught in this land of like telling the $1 billion story and chasing that $1 billion story at the expense of still a very real, very venture scale kind of business that just needs a different path to be able to do it. And so when you talk about like what kinds of filters we think about for who should raise venture, who shouldn't, you know, that's one of the filters that I think people should consider, right? Like Ryan didn't have to build breakthrough technology until he was going after the enterprise. He could like piece together a relatively simple MVP. He could, like, venture is designed to do a couple things really well, you know, like long development cycles between, you know, building the new technology that doesn't exist and being able to monetize it. But most, I mean, the reality is like most companies aren't that. Most companies aren't building rocket ships. They aren't building, you know, brand new threads or strands of AI. Like there's just, that's what it's designed to do. And so if you can find yourself outside of that, or if you find yourself outside of that, it doesn't mean you're not a venture scale business. It just means you need to take a different approach. I think Ryan's a really great story of that. Atlassian's a great story of that. GitHub's a great story of that. Spanx is a great, like there's so many companies that would have not achieved what they set out to achieve had they gotten caught on that treadmill or recalibrated to that unicorn market opportunity at the expense of something that was very, very real in the near term. And so that's how we think about it.
Thank you. That was awesome. And I love that story. Lolita, and maybe this question is not interesting based off what Bryce led with at the beginning of the session, but I'm curious how you think about, like, having seen people do different funding models, like how does the storytelling change? I guess what do you see people focusing on when they're actually doing that fundraising process, depending on who the audience is? Like what changes in terms of the prioritization and how you think about that?
Yeah, that's a great question. And thank you, Stephen, for giving me that one prior to the call, because I wrote some notes and I think it'll be easier for me to share them. I'm sharing them in the chat as well, because
Awesome.
I think storytelling is so important depending on the type of capital. So here we're assuming you know what kind of company you are, you know what you're going after, why you're raising, and now we're down to what story are you telling? Storytelling will sound so different depending on your audience. Who are you selling to? So when we talk about bootstrapping, it's so much about selling to your customer, because the best way to get capital for your business is your customers. So you really need to focus on what problems are you solving for people or organizations that you're serving. For grants, that's another option for capital. It really depends on, grants have different type of requirements, so you want to read them and again, sell to your audience. For debt, I think a big piece in debt is reassuring debt people who are giving you debt, right? That you're going to be able to repay it in some way, shape, or form. That is part of how they will be convinced to give you money. Angels, I think, are such a missed opportunity in so many ways, because angels are just rich people who can decide what to do with their money, and they can want to invest in you because they like you, because they care about the business, because they want to just be in the ecosystem. There's so many reasons. So angels are a really flexible way to tell your story, but you need to know your audience. Pitch competitions can be a little blurry, but I just kind of group pitch competitions and VC, because it is really going back to what a lot of Bryce was talking about, pattern matching. And a lot of the pattern matching is around, have a big problem you're solving in a really big multi-billion-dollar market, where you have a solution that's differentiated in the market, that you have the right team. So it means you know the industry, or you have some sort of differentiated value in it. And then that you will be able to scale the company, because when you're going out for VCs want to know that you're going to be $1 billion company. So how are you going to get there? Having that storyline, and not just telling it, but having those assumptions that you've driven in and how you're going to build out. Now, there's two other ways to get capital, and the stories may differ. And I'm going to defer to Cheryl and Bryce to talk about what kind of story, what do you have to focus on in terms of the story you tell when you're doing equity crowdfunding, or you're going after capital from more of an alternative source, indie VC, who Bryce just said it, right? We're looking to fund companies who are focused on building the business profit. Cheryl, Bryce, can you jump in and maybe share, like, what would you have people focus on within their story if they are going for either of the paths that you support?
I was just writing that in the chat though, so I'm so glad that you teamed me up on this side. But yeah, there are some questions about like, you know, what are investors looking for? Like, what's the story that I would think makes more sense? And I guess it's still to the point of traction, right? Is making sure that you're able to show month-over-month growth. You're able to also show at the end of the day why you, right? Why are you building this particular company at this time? And why do you think they will actually be a $1 billion company at some point? And so, and by the way, we don't have that kind of forced time period of like VCs who say like, hey, you know, you have to exit by this, by, you know, X number of years, right? I think customers and investors really want to be along for the ride. So they're totally fine with a much longer time period as long as, you know, they either IPO or get acquired, because that's at the end of the day how investors get a return, right? And so, yeah, so they really want to go, they really want to back a founder that they love, right? So the team, right? They really want to understand the traction. So the month-over-month growth. Then they also want to see the tech or the product, right? Is this product, does this have a competitive advantage? Is there a defensible moat? Are there things to that will make this be the best that there is, right? That because they want to also just choose the best. And then last but not least is, I guess, theme. There's definitely a bigger push now to support more underrepresented founders from geographical areas that may be overlooked. And so, as you can see, team, traction, tech, and theme. These are the 4 T's that we use in our due diligence process to make sure that we're holistic, that we really understand the company as a whole. And I'll drop those into the chat so that so I can finish my answer there. But that's kind of hopefully a better rubric for you guys to remember: team, traction, tech, and theme.
I would tweak one thing, and that would be billion, you know, especially when it comes to venture. I know we talk about the $1 billion exits, but I will tell you right now, $1 billion exit doesn't move the needle for most VCs even these days. So I would say a better calculus to be thinking about is, can you return the whole fund versus, you know, can you, you know, generate $1 billion in value? Because, you know, I think we've anchored on that as a number, but I know plenty of investors, especially early stage investors, who have had $1 billion outcomes and it returns 20% of the fund or 30% of the fund. So anyway, this is, I'm so deep in the weeds on this sometimes I just can't help myself. But when it comes to you know, kind of what we think about or what we look at, we've tried to keep it as simple as possible. I mean, I think one is like the fundamentals. So we want to see, you know, we similarly, we invest in post-revenue companies. They have to be real. But, you know, there's a range of, you know, kind of where they need to be on the realness spectrum in terms of, there's no like magical number. What we do need to see is like solid gross margins. So, you know, if they go on to become kind of a profitable, sustained business on their own fuel, you know, is there enough gross margin in the business to matter? So our you know, what we look for is 40% or more. I would say the other thing that really drives our thinking is like, you know, it's certainly the team, but just as importantly as the team and what they've done historically, it's like, what's the insight they have? Like, what do they see? You know, a phrase we use is called directionally correct, but out of favor, right? There's a lot of, you know, anybody who tracks VCs know that every 6 months, there's a new hot thing everybody's chasing, right? So like 2 years ago, education was totally out of favor. Healthcare was totally out of favor. Now it's totally in favor and everybody's chasing those deals. And 6 months ago, future of work was like the hot thing and no code was the hot thing. And now everybody's chasing something else. And it's like, if you find yourself directionally correct, if you find yourself in one of those markets, you're not wrong. But if you're going to be relying on being able to raise funding every 12 to 18 months, like I wouldn't want to bet on some of those trends, because if you were in VR, you know, 3 years ago, like even now it's nearly impossible to raise funding for a VR company, despite one of our V3 companies, you know, growing really, really fast. They're in VR. They just wouldn't be able to raise, you know, they wouldn't be in a position to raise. And so we think a lot about, you know, kind of where the world's going and how some of these more independent businesses that don't have to rely on funding could potentially see that inevitable outcome but might not if they were having to kind of play that game.
And before I open up to the crowd, I just want to see, Brittany, do you have anything to add? I guess, like, what is unique about the stories that you think resonate with you all at Impact America Fund? I know you talked about it a little bit, but just to get a little additional insight there.
Yeah, I think the only thing that I would add to that is just we're Impact Fund, so really understanding the impact story to demonstrate that, as a founder, you really, really thought that through and are using a metrics-based approach to understand the impact your product or service is having on the communities that you're serving, and being thoughtful about, as the company grows, how do you grow that impact, and demonstrating through your technology and product design, you're thoughtful about what are the continued needs for the community in the area that you're serving. So I agree with what everyone else mentioned, but for us, it's also really understanding that impact story. And then lastly, the why. So why are you best suited to solve for this particular problem for this group of people?
Yeah, no, I love that. Founder market fit is kind of a buzzword that's happened in the last 2 years, but I think it's pretty real. So that's a great addition. Okay, we're going to open it up to the Q&A from the crowd. We're going to kick it over to Ian Grant, who has a great question. And then we're also going to ask Dolly to add her addition to the question, because I think it's an important one. So Ian, we'll go to you first, and then Dolly, if you can wrap it up.
Sure. How's it going? Thanks for having me, and appreciate everyone for all the support you guys are providing on the call. Basically, my question is around family and friends raising. I'm just curious on, what paths you recommend an early stage company like myself taking for that raise. So are you asking family and friends for equity? Is it, a debt raise? You guys just spoke about debt and making sure you can pay that back, but was just curious to see what's common and then ultimately what you guys recommend.
Dolly, you want to add your piece?
Yes, can you hear me? Sorry, this is my wife's account.
That's great. Yeah, we can hear you.
Yeah, so regarding the family and friends round, I believe there's a major gap for most minorities on that portion, as far as like we don't have access to those potential angel investors or friends and family who have high net incomes. So where is that? I think that's the major disadvantage for us. We just want to know, is there an alternative to that? Because we know that's basically the start of your investment process, your fundraising process, but a lot of us don't have that round to cover. So where do we begin as minorities?
It's awesome. Looks like Lolita wants to jump in here.
Yeah, I do want to, because I get to work with a lot of underestimated founders, and I am also trying to figure out, how do you start something when you don't have money and your friends and family don't have money either? And you're like, well, how do I do this? And you have the chicken and the egg problem. So unfortunately, maybe the answer that I give you isn't going to be the thing that you like, but here are some things that underestimated founders that do not have access to family and friends do. One is you stay on your full-time job and you work at your startup as a side hustle, evenings, weekends. Another thing is you look for grants, you look for pitch competitions, and you might even side hustle as a consultant or a speaker, something like that, to get some capital. And this is just the real talk on how people do it. Now, investors in the traditional ecosystem will look down on this and will say, well, no, I have some investors will actually say, I will not invest in you if you're not working on your company full time. But I get it, guys. Like, some of us don't have the luxury of just kicking back and working on a project because we have bills to pay. And more than that, you didn't mention this, Dolly. I don't actually know if that's your name or if it's your wife's name, but you didn't mention this, but a lot of us from our background have family that we actually need to support. So it's not just us, it's not just college debt, it's not just, whatever, it's also family we need to support. And so we need to get really scrappy. We do need to work extra hard. That's just the reality for so many of us. But again, there are these programs that are grants, that are pitched competitions, that are your side hustles. And I encourage all of it and support it all, because sometimes that's what you have to do. The other thing I would say is you have like Cheryl, who will jump in probably. She's just getting ready to talk about it. I won't steal her thunder. But another thing is that you may actually be able to build relationships and connections on Twitter and actually get some capital from angels. Again, angels can do whatever they want with their money, right? So if you build relationships with people who are accredited investors, and I'll drop a link so that you know what that means. You want to have people who are accredited if you take money from angels. But I have also seen underestimated founders take money from angels, new angels, maybe old angels. Typically, there's like this new wave of angels that are coming up that are just like, I want to invest. And so you have an opportunity there too. With what's happening with COVID and everything else, it might be complicated. But again, I would say there are plenty of options. They're not the best, and they're not going to be like the white guy who dropped out of Harvard and wrote on a napkin and raised $10 million from their friends over lunch. But there are things we can do, and there is an emerging community that wants to support you. And I am one of those members. Bryce is one of those members. Cheryl's one of these members. And although I don't know Brittany too much, it sounds like she is too.
Awesome. Thank you so much, Lolita, for that. I grapple with this question a lot too, simply because I actually, before I joined this hybrid startup VC world, I actually wanted to do a startup. I've been entrepreneurial all my life. Like, I sold Pokemon cards in first grade, resold them into third grade, did the whole lanyard, what was it, yo-yo stuff. Like, I made money. My mom was scared about how much I made money for, but she was like, okay, clearly something's up. So at some point I will be an entrepreneur. I just don't know for what yet. I have a couple ideas, but we'll see. But the thing is, I've asked myself this question too, is like, okay, if I were to start a startup right now, where would I go? I did just repost it in the chat right now, but since it's so active, it's all the way at the top now. But I did kind of map out where, like, what are all the different types of capital sources, and the ones that I put for friends and family were really just either your network, which, I mean, for us, unfortunately, is not as much. But at the same time, actually, one thing to plug is Camelback Ventures. That is the one that I would do actually if I were to start a company. They give you $40,000. They kind of act as the friends and family around, and it's for underrepresented folks. And they actually have a great program for 6 months that really talks to you about all these different things. And you don't really take much at all, actually. And I know the guys over there are so sweet and just absolutely rock stars. So I would recommend plug them in. I would also, plug in the pitch competitions that Lolita was mentioning. I would probably just do those all day, every day. I actually know some people who are doing those and actually don't really have businesses behind them, which I think that's just rude, but we can talk about the hot takes much later. I know we have a little bit of time. But that being said, I'm just plugging that in there, and yeah, go from there.
Just real quick, I don't know if anyone wants to add, but I think just to loop back to Ian's initial question, like, how do you structure it? Is it equity? Is it debt? Do you do loans? Do you do unpapered loans? Do you do rev shares? Like, what does it usually look like? Anyone have thoughts there? Maybe I can call on Bryce. What do you see, having been in the industry for so long? What's typical?
I mean, most at that stage are like notes or convertible notes. I think, when you are just an idea, it opens up a huge opportunity for people to hustle you for really unsavory terms if you're selling equity at that point. And so, I mean, one thing we try to do is we've developed our own set of terms that kind of capture a bit of both worlds, right? In terms of, the features of a convertible note accompanied with, the revenue share as well. We open source those. Those are published online. Anybody can download them and deploy them without needing an attorney to jump in the middle. We worked on them with Fenwick and West, who did the Series C documents. So, they're pretty well vetted. We've used them across about 30 investments now. But generally, I would encourage people to, try to set up a convertible note at that early of a stage with some kind of discount or some kind of cap. rather than, selling 50% of your company for, I mean, you don't want to get into, what is that, the I don't watch the show, but you know the one I'm talking about, right?
Shark Tank?
Yeah, it gets Shark Tank real quick. So I would caution you seriously to avoid selling equity too soon.
That's great advice. I'm going to kick it over to Kadesha, and hopefully I pronounced that right, but I think this is a great question about kind of the changing landscape of the market.
Yeah, so I've found that while raising funding, a lot of the funds that advertise as seed rounds, first money in, they have the expectation for the metrics to be what I would think would be more aligned with the Series A. So it's quite difficult, I've found, to find true pre-seed and seed funds that actually will be the first money in while you're still finding product market fit, while you're still building up those metrics, even if they do believe you're a scalable company. So I just was wondering if you guys have any insights on some funds that are still like true seed rounds, specifically like what their names are, or if there's a better approach if you do have a very scalable business and you need a little bit of money to get those metrics to go to some of the larger, more traditional seed companies, seed funds.
Anyone chomping at the bit to answer that one? Lolita, do you have thoughts?
Lolita built the matchers, so this feels like it was custom made for her.
Oh, I guess I should talk about it. Thanks, Bryce. So here's the thing though, and this is why I didn't want to talk about it before. So I built with my husband the Startup Investor Matching Tool, and the goal and the mission of it is to connect underestimated founders with investors and capital. And now the reason why I haven't mentioned it is because you really need to figure out what kind of capital you need. And I don't want to guide anyone into, you need to go to angels, investors, the traditional model. You have to figure that out. But if you figure that you want to connect with angels, investors, VCs, Josh and I built a tool called the Startup Investor Matching Tool, where you enter your information as a company, and we have investors that have shared their thesis, investment criteria with us. We match them, and then basically investors will ask for a double opt-in intro to you as a founder. And then I personally make the intros because I am very protective of our community. And here's what we've done so far. We have over 250 investors on the platform right now, and they're primarily pre-seed seed, and a lot of them do invest pre-product, pre-revenue. And on the founder side, we have over 700 startups who have submitted. Over the last 2.5 months, which that's how long it's been alive, we have seen over 150 introductions and 6 checks written. And this is a passion project, what Josh and I spend our Saturdays doing. And I'm more than happy to help you guys, because none of us who are on the line can write all the checks and support everybody. But as a community, we can do a little bit more. So if this is something that's interesting to you, I'll drop the link so you can learn more about the Startup Investor Matching Tool. But let's not forget what Bryce said. Why are you raising? And thinking about what kind of capital makes the most sense for you and your business.